Hello, and welcome to myfinanceteacher.org. As you know, recently there has been a nice strong rally in a lot of uranium producers, mostly due to recent US legislation about strategic uranium reserves. So with that recent rally in mind, let's have a look at a range of uranium producers, starting with Cameco. And of course, the factors that I'm going to look at are the uranium prices, the reserves and the resources that the company has in the ground, the production costs of those reserves. Cameco also provides fuel services in processing uranium. We're also going to look at long-term debts, we're going to take into account the time value of money, and finally arrive at per share value of the company. The sources of all the data used here are the 2019 annual report, Q3 report this year, the reserves and the resources overview on the website itself, and Yahoo Finance. In uranium prices, let's look at 30 in the balanced scenario, 27 for conservative scenario, and $42 for optimistic scenario. Whether $42 is optimistic enough for uranium prices over the next, say, several years, you let me know in the comments. I'd be really interested in your opinion here. Looking at the reserves and the resources, the company has proven and probable reserves of 461.2 million pounds and measured and indicated resources of 424 million pounds. The production costs this year in 2020 for the first 9 months of 2020 are quite high, actually higher than the price of uranium. The costs per pound are very high because of very low production, shutdown of the largest mine that Cameco has, and because of the extra costs related to the pandemic. So instead, let's have a look at the 2019 costs per pound, which were $26.3. At least those are below the ongoing market price, as well as below the price that the company gets for its uranium. In addition to producing and selling uranium ore, Cameco also provides fuel services in processing uranium from oxide yellowcake into UF6. So far in the 9 months of 2020, the gross profits from fuel services were around 50 million US dollars. The company reports 65 million Canadian dollars. Annualized, that will give you around 66.7 million US dollars. And I arbitrarily took 70% of that to come to net profits. Otherwise, though, from data that I found so far, it's hard to find the actual net profits in relation to fuel services alone. For long-term debts, the company reports 997.2 million Canadian, which gives you something around 770 million US dollars. For shares outstanding, the company has nearly 396 million shares, with the insiders holding only 0.17%. And for time value of money, I'm only going to use a discount rate of 3% to give some benefit of the doubt for this company, as the valuations are not that great compared to the ongoing market prices. Mine life is 16 years, that's the reserves divided by annual production so far. And of course, in addition to producing uranium ore out of the ground, the company also has some revenue from fuel services. So what I'm going to do is I'm going to take a present value of this net profit from fuel services expected over the next 10 years, divide that by the number of shares outstanding, and add this to the valuation based on extracting the ore itself. So with all of that in mind, let's have a look at conservative valuation with the uranium prices of only $27, where we only include proven and probable reserves and fuel services over the next 10 years. That will actually give you, surprise, surprise, a minute valuation of far below $1, which kind of makes sense, as conservative valuation includes prices which are really close to the cost of production, meaning that there is basically almost no value to the reserves in the ground. As the company states in the Q3 report for this year, that's been one of the reasons why the largest mine has been on a shutdown for quite a while early in 2020. Next, looking at the balanced valuation, we're going to use the price of $30 per pound, again looking at only proven and probable reserves, plus the fuel services net profit over the next 10 years. That, again, surprise, surprise, gives you a valuation of under $3, which is still far below the market price of over $13 at the moment. But whether you think this is really a balanced scenario where uranium prices stay at around $30 over the next several years, that is questionable, I would guess. And finally, coming to the optimistic valuation, let's plug the uranium prices of $42. We're going to plug the proven and probable reserves and half of measured and indicated resources, as well as the present value of net profits from fuel services over the next 10 years. That finally gives you an optimistic valuation above market price at $15.36. But even then, it's only around 16% above the ongoing market price. So to be honest, it's a little bit puzzling. So if you have any ideas on nice adjustments to make to come to a more realistic valuation to the company, please share your opinion in the comments. I'd be really interested to read those comments. Possibly the market valuation right now is a little bit high with the recent news of the Senate approving the bill for National Strategic Uranium Reserve. That's just since the beginning of December, which pushed the prices of those uranium producers significantly higher. On the other hand though, looking at a longer term chart, monthly chart, back in mid to late 2000s when uranium prices were much higher, as high as $70 or $100 per pound, the share price of the company was also significantly higher at around $40 to $50 per share. So on one hand, looking at the chart and the future potential for uranium industry, I think there is a really bright future in all of those uranium producers. But on the other hand, just looking at the math of our valuations, I don't really see anything to make me really excited. Perhaps it's the prices that I'm plugging into these valuations that is still a little bit low. Again, let me know what you think. For now, I will leave you to ponder about that. Have a nice day and good luck in your trades.